Welcome back, everybody, to another episode of Multifamily Investing 101. I'm your host, Travis Watts, the Director of Investor Education here at Ashcroft Capital. In today's episode, what we're talking about is risk premium and what you need to know. Disclaimers, as always, never financial advice, not telling you or anyone what to do with your money, so please always seek licensed financial advice. So to kick it off, a simple way to look at what is risk premium, it's the premium that an investor requires to take on additional risk. So take on additional risk from what? So first, as investors, we need to think about what is the safe money. And when I say safe money, I don't mean the guaranteed yield or the risk-free money. I'm talking about what's generally considered to be low risk, low volatility types of investments. For example, a US Treasury bond that yields 4%, let's say, or a high yield savings account that's FDIC insured with an established bank that's paying their depositors 4%. So if we use 4% as our benchmark for what's considered generally safe in terms of investing anyhow, now we can measure that up against what it is we're actually looking to invest in. So let's say you or I are looking to do a real estate project and it's projected to provide an 8% annualized return. Or maybe you're looking at a dividend paying stock, a company that's currently paying 7% annualized. So that 3 to 4% in additional potential yield is what's considered your risk premium. That's you getting paid more for taking on the additional risks. So what do you look for when you measure risk? Well, there's a lot of things you could look for, but probably the top three would be default risk, liquidity risk, and price fluctuation risk. But remember that the list goes on from there. As the saying goes, higher risk, higher return. So what's really important is for you to identify what your risk tolerance is and what's an appropriate investment for you. So I'll share with you a really quick story from a couple years ago. I don't do much in the world of stocks, but I do have a brokerage account, and I noticed that a pretty substantial company had fallen about 50% from its all-time high level. And I decided in that moment of seeing that I was going to take a position. I was going to make an investment in hopes that maybe that company would turn around quickly, it would recover its losses, and I could potentially double my money. Well, unfortunately, what ended up happening in my case is the stock just kept falling and falling and falling. And I ended up with about a 35 to 40% loss when it was all said and done. And the lesson there is that if I was paying attention to risk premium and I was truly thinking to myself, you're going to make potentially 100% return on your money in a very short time frame, that's going to come with a lot of risk attached. Remembering higher risk, higher return. So let's talk about you. Let's assume that you have $100,000 to invest today. The first thing I'd recommend is starting with what your actual goal is. What are you looking to achieve by investing? Some investors are looking for the preservation of their wealth, meaning they don't want to take a lot of risk. They certainly don't want to lose money. So maybe they just want to maintain or grow very steadily on their nest egg. On the flip side, you have very aggressive investors that are looking to amplify their net worth. So what is it for you? And number two is to identify what types of investments can help you meet those goals and objectives. So using the example of the US Treasury bond or the high yield savings account, that would be in alignment with somebody looking to preserve their capital and grow it very modestly. On the flip side, if someone's going to be very aggressive and they're looking to amplify their net worth, they might be looking into more speculative investments, maybe startup companies, venture capital, flipping houses, you name it. And number three, it's important to consider the outcomes. In other words, are you comfortable with growing your $100,000 portfolio at 4% a year? Is that going to help you meet your goals and objectives? On the flip side, if you decide to be more aggressive, how comfortable are you losing your money? What if you put that 100 grand into an investment that went to zero? What if you lost 50%? How does that make you feel? That's going to help you identify what your risk tolerance is. So in conclusion, there is no right or wrong way to approach investing. What really matters is what you're trying to achieve and what your goals and objectives are. And I want to leave you with two quick case studies to help paint this picture a little more broadly. The first case study is, let's say Bob, a business owner, just sold his company and came into a huge windfall of cash. And let's say now Bob has $10 million to go invest. Well, Bob may find that it's appropriate in his situation to seek out those safety plays, the safe money, quote unquote, because after all, if you could invest $10 million at 4% a year, that would be $400,000 in income annualized without much risk to the downside. On the other hand, we'll use the example of Scott, who's a 20-year-old with $10,000 to invest, and he's just getting started in his investing journey. So if Scott's goal is to aggressively grow his net worth, then the safety plays might not make any sense to him. He might look for higher risk, higher reward, speculative investments, startup companies, flipping houses, you name it, because ultimately he is young enough to recover from any potential losses early on. And after all, it is his goal to grow the nest egg at a faster rate than, say, 4% a year. So with that, I hope there was some value in this short episode on risk premium, what it means, and how you can apply it in your own life. I'm Travis Watts. If you ever have questions, want to reach out, take a deeper dive, you can reach me at travis@ashcroftcapital.com. To learn more about current offerings and opportunities, visit ashcroftcapital.com. Thank you so much for being here. Until the next episode, have a great week, everyone.